In one of our previous videos, we talked about emergency funds. You have your emergency fund, you have a separate savings account. Good. But here is a question most people never think to ask. Is that savings account actually working for you? Or is your money just sitting there, doing nothing, while inflation quietly eats away at its value? Today, we are talking about how to make your savings work for you, what interest on savings actually means, what types of accounts give you the best rates, and how to find the best option wherever you are in the world. When you put money in a savings account, the bank uses that money. They lend it to other people, make investments, run their business. In return for letting them use your money, they pay you a fee. That fee is called interest. Interest is expressed as a percentage of your balance per year. This is called the annual percentage rate, or APR. Sometimes it is called annual percentage yield, or APY. APY accounts for compound interest within the year. It is usually the more accurate number to compare. If you have $1,000 in a savings account with a 2% annual interest rate, the bank pays you $20 over the course of a year just for keeping your money there. That is $20 you did nothing for. The interest is free money on top of what you already have. And as your balance grows, so does the interest you earn. Not all savings accounts pay the same interest rate. A basic savings account at a traditional high street bank might pay you 0.1% interest per year. On $1,000, that is $1 a year. A high interest savings account might pay 2, 3, 4, or even 5%. On $1,000, that is between $20 and $50 a year. Now, scale that up. If you have $5,000 saved, the difference between 0.1% and 4% is the difference between $5 a year and $200 a year. Same money, same effort, just a better account. Most people have no idea their savings account is paying them almost nothing. That stops today. Let us look at the types of accounts that actually give you better rates. So, what kinds of accounts actually offer better rates? You do not need a digital bank or a fintech app to access higher interest. There are several options, and the right one depends on where you are in the world and what you need from your money. The first option is a high-interest or high-yield savings account. These are offered by both traditional banks and online banks. Online banks, fully licensed banks that operate without physical branches, tend to offer the best rates because their lower overhead costs allow them to pass savings on to you. In the United States, banks like Ally and Marcus by Goldman Sachs consistently offer competitive rates. In other markets, look for the online or digital arms of established banks rather than your standard high street branch. The second option is a fixed deposit or term deposit account, offered by traditional banks in almost every market. You lock your money away for a fixed period, 3 months, 6 months, 1 year, and in return, the bank pays you a significantly higher interest rate. The trade-off is access. This makes it unsuitable for your emergency fund, but an excellent option for savings you know you will not need in the short term. The third option is a credit union, member-owned, not profit-driven, consistently offering better rates than traditional banks. Available in the US, UK, Nigeria, Kenya, and many other markets. The fourth option is government savings schemes. Premium bonds in the UK, I-bonds and Treasury Direct in the US, Treasury bills in Nigeria and Kenya. Government-backed, essentially zero risk, and often competitive with or better than bank savings rates. The fifth option is a money market account, offered by traditional banks and brokerages, paying higher interest than standard savings while still allowing relatively easy access. The pattern is the same everywhere. Traditional savings accounts pay very little interest. Online banks, credit unions, government schemes, and money market accounts consistently offer more because they either have lower costs or different incentives. Know your options, then choose. So, how do you choose? Here are 4 things to look for wherever you are in the world. Number 1, the interest rate. Compare rates across at least 3 different institutions. The difference will surprise you. Number 2, is the rate fixed or variable? Fixed gives you certainty. Variable can go higher, but can also go lower. Know what you are signing up for. Number 3, access and liquidity. For your emergency fund, you need an account where you can access your money within 1 to 2 business days at most. Some high-interest accounts lock your money away for months. Those are not suitable for an emergency fund, but they might be suitable for other savings goals. Number 4, is it safe? Make sure the institution is regulated and your deposit is protected. In the United States, FDIC-insured accounts protect up to $250,000. In the United Kingdom, the FSCS protects up to £85,000. In other markets, check whether your central bank or financial regulator provides deposit protection. If it is not regulated and protected, it is not worth the risk. Your savings account is not just a place to park money. It is a tool. And like any tool, the right one makes your work easier. The wrong one slows you down. You save the money you were going to save anyway. You just make sure it is in the right account so that the bank pays you fairly for using it. The difference between 0.1% and 4% might seem small today, but over 5 or 10 years, on a growing balance, it compounds into a significant amount of money. Money you earned by doing absolutely nothing extra. That is your money working for you while you sleep. Interest on savings is the fee the bank pays you for keeping your money with them. Not all savings accounts pay the same rate. There are 5 account types that offer better rates: high-interest savings accounts, fixed deposits, credit unions, government savings schemes, and money market accounts. Compare the rate, understand fixed versus variable, check access, and make sure it is protected. Your action step: find out what interest rate your current savings account is paying you. Then spend 20 minutes comparing it to at least 2 alternatives in your market. That 20 minutes could be worth hundreds of dollars over the next few years. Subscribe to Money Glow Up TV so you never miss a new video. And if you have any questions or feedback, put them in the comments. I would really love to hear from you. See you in the next video.